Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is March 2nd of 2021, and we have a lot of headlines we're going to address today. Markets have been moving last week and this week, so let's get right to our topics of the day. Thanks for watching. So 3 topics of the day. Over-stimulation is on its way. We had a yield shock as well as the reopening is happening. And let's start with the S&P 500 earnings. We just concluded earnings season. The fourth quarter was reported by S&P 500, and 10 out of the 11 sectors have reported and exceeded expectations and beat on the estimates. The only one that was in the negative that didn't quite make above the analysts' expectations was energy. It was a lagger last year for all the obvious reasons. It still barely came into the last place spot by a long shot. But at the same time, the other 10 of the S&P 500, if you look at the S&P as a whole, what was really interesting to round out this earnings season is essentially the year-over-year earnings beat in terms of earnings growth was 4.2%. Now, we had a government shutdown, a pandemic globally speaking, but corporate America, as measured by the S&P 500, had an earnings growth of over 4%. No one could have predicted that. And ultimately, that really speaks to the efficiencies of well-run businesses, the advent of technology pull-through, as well as the consumer being able to adapt. And obviously, there was a lot of stimulus while we were at home. A lot of corporate America was able to capture the minds and hearts and ultimately the dollars of those who can shop online. And obviously the Federal Reserve did their backstop and their fair share of backstopping the economy, while Congress gave dollars in hand because consumer discretionary was one of the top. Materials was actually the top year-over-year growth of 22%, a little bit above that. Financials as well as technology both rounded up with 20%. Those are the 3 best performing sectors with earnings growth year over year. Ultimately, when I say over-stimulus is on its way, yeah, that's exactly what I mean. Let's talk about this. Right now, if you put into context what we had in all of 2020 by, again, the Mama DSNL, Federal Reserve, as well as the monetary and fiscal policy combined, and you count in what the House just passed of the $1.9 trillion Biden proposed additional sort of aid on the way. Who knows what the Senate's going to do, but ultimately it's going to be a plus or minus that number. You know, when you're at $1 trillion, what's an extra billion here and there, ultimately speaking, is the way Washington views it, not me. But the reality is that the market is already anticipating that money working its way into the system. Let's put that in context, as I said before. If you go back to 2008, 2009, the all-in assistance from the Federal Reserve as well as monetary fiscal policy combined, it was 5% of the GDP of the U.S. at the time. If you take this year right now, combined with last year, already has been done, you're at 55% of the U.S. GDP. So when clients are asking, what do we think about the market? Where do we think the direction of the market is? Well, you know as well as I do that if $1 goes in the U.S. consumer hands, 2/3 of the U.S. economy is driven by the consumer. If $1 goes in the consumer's hands, what are they going to do? They're going to save it? No, they're Americans. They're not going to save the dollar. They're going to spend it. And what's going to happen is that's going to work its way into corporate balance sheets, earnings, so on and so forth. So we do believe that markets will grow higher from here, predicated on earnings. And if you don't believe me, I just reported that last year we had an earnings growth year over year. So with an additional $1.9 trillion in stimulus, I think it's a safe bet to say earnings will grow in corporations that are smart enough to figure out how to sort of pry that away from the U.S. consumer and get that on their balance sheet. I'm not going to bet against that or the U.S. consumer spending the money. And in the meantime, why did the market go down over the last couple of weeks? Well, if you're following me, and ultimately what I've been forecasting and also reporting on played out and predicted. If you're with me on my outlook for 2021 in January, it's still on YouTube. It's about an hour long if you want to watch it. I talked about the top 5 things we should be concerned about, and that's ultimately yield shock, which is the 10-year treasury, right? So with all of this growth and all this stimulus, you have corporations earning money. You have the U.S. government giving out money from helicopters to all the U.S. consumers. What's going to happen? Interest rates are going to go up. Last week, we had the 10-year treasury go up to 1.6%, which was a shock to the system. Stock prices came down as a result because wait a minute, the Federal Reserve is trying to keep interest rates down. Not so fast. Yields will be moving independent of what the Federal Reserve tries to manipulate. They try to manage the balance sheet and manipulate yield curve on the short end. But the long end, the 10-year Treasury, and even longer on the 30-year, they really can't do too much to control that. What the yields growing higher show us is a picture preview into the future, saying that the economy will be on fire going forward. So there is some confidence that, yes, we are reopening. Texas just announced no mask mandate and 100% reopening today. If you think about all the business headlines that we've been reading recently, especially from First Trust, or Brian Westbury, First Trust, and a few others, a lot of the last 48 hours, the news cycle changed this week. Obviously, we got our third vaccine online, but really we have, if you're reading the journals and really the investment journals, you're really seeing everyone's pointing to April and May in the United States for herd immunity. Europe, just in the UK, they just released or basically projected that their travel ban will be lifted in May. I read 3 or 4 other financial institutions and medical journals saying May. So everyone's gearing towards May. Obviously, this could happen where there could be setbacks with the virus. There could be different things that could play out. But I wouldn't bet against what I'm reading right now, because all of a sudden, 48 hours later, something has changed. So we are going to see, I think, herd immunity sooner than later. At least that's what markets are sort of anticipating and predicting. And we have the 10-year Treasury that's acting up like a 2-year-old, like a tantrum, saying, wait a minute, not so fast. So this is all going to play out. I'm going to talk about this in nauseam going forward, because the interest rates are going to be ultimately the story. And the real story behind that is going to be the Fed policy. Really, if we look at all of our last recessions, the Fed has created the bubbles, and it's their policies that have really created the corrections. So a policy error is what we want to be clued in on a go-forward basis, because yields will be rising as the economy takes off. If the economy takes off, again, in May or the summertime, as more and more people get out there, feel healthier, safer, so on and so forth, the economy is going to go roaring, especially with when you have 55%, that's $10 trillion, guys, that's in the U.S. economy. And the M2 money supply shows that consumer is healthy enough to have way about 17% more than expectations, historically speaking, on the balance sheets in the banks. So this is going to work its way in. This could be a multi-year expansion, but S&P 500 markets go up and based upon earnings, and earnings went up last year, believe it or not. So that's the story in a nutshell here. We are doing our best at Blanke Schein Wealth Management to keep you informed, up to date, and more importantly, making some money, because that's ultimately how we get out of this on a day-by-day basis. That's our job, to do that for you. So we appreciate it. Thanks for watching. See you guys next time.